Welcome to Continue Learning GuoLaoTou channel, comprehensively understand blockchain from 0 to 1. The 7th lecture, Bitcoin Mining Upstream. Part 2. In this class I will explain mining farms and mining pools to you. In the previous lesson I talked about mining machines and miners, and you learned about the history of mining machines and how to choose them. In this class, let's discuss mining farms and mining pools together. Through this lesson, you will learn how to operate a mining farm, what preparations are needed for farm operation, and how to collaborate with mining pools. The cost of operating a mining farm includes construction costs, equipment costs, maintenance costs, network costs, and various other expenses. Maintenance costs include electricity costs and labor costs, and the difference in these costs can be significant. This is why mining farms are often located in places with relatively cheap and stable electricity, because once the mining machines start running, they work 24 hours a day, so having a team that can work in shifts 24 hours a day, 7 days a week, is essential. With the increasing specialization of mining farms, the design of a mining farm, including the quality of its water cooling, air cooling, and circuit design, can significantly impact maintenance costs and profits. Early mining farm operations were relatively rudimentary, with miners setting up rigs and starting operations. However, it was soon discovered that this approach led to significant machine damage and high maintenance costs. Ventilation and dust-proofing solutions were introduced, followed by strict control of indoor temperature and humidity. The entire mining farm operation scheme continues to evolve and upgrade. Mining machines can be noisy when running, with the noise level reaching 73 decibels at a distance of 1 meter from a single machine. When thousands of mining machines run simultaneously, the impact on the surrounding environment is considerable. Therefore, some mining farms have been designed and modified to become silent mining farms. Operating a mining farm involves risks, including policy risks, technical risks, and initial investments, all of which can be substantial. The payback period for a Bitcoin mining machine, depending on the price of Bitcoin and changes in computing power, is approximately 300 days, plus the cost of maintenance. Therefore, investing in a Bitcoin mining farm requires a strong risk tolerance. Now that we've covered mining farms, let's talk about mining pools. Compared to mining farms, you might find mining pools more interesting. So, what exactly is a mining pool? A mining pool is essentially a collection of computational power. In the early days of Bitcoin, there were no mining pools, and miners performed calculations and transaction block generation individually. As more people joined mining, the individual probability of a miner successfully mining a Bitcoin block decreased significantly. What's even more critical is that in such low probability situations, relying on these probabilistic earnings became increasingly unstable. An average miner or mining farm might only mine 1 block per month, creating substantial financial risk. As a solution, someone had the idea of pooling everyone's computational power together to increase the probability of mining a block. Then, the rewards from mining that block would be distributed among the contributors based on their computational power. Hence, mining pools were born. In a mining pool, mining machines handle the hashing computations, while the mining pool handles the transaction block generation. This means that mining power competition and block validation are separate actions performed by mining machines and the mining pool, respectively. So how does a mining pool convince miners to join and contribute their mining power? Here, let me introduce you to 2 mainstream cooperation models for mining pools: PPS, pay per share, and PPLNs, pay per last N shares. PPS guarantees miners a fixed daily income based on their proportion of computational power within the mining pool. The pool prepays this income, so as long as a miner's machine maintains a stable speed, their daily Bitcoin earnings will be consistent. This is known as a fixed input, fixed income model. On the other hand, PPLNs pays miners based on their contributions to the last N shares of the mining pool. This model introduces an element of luck. If the mining pool mines more blocks in a day than theoretically expected, miners receive more rewards. Conversely, if the pool mines fewer blocks, miners receive fewer rewards during that period. PPLNs is a fixed input, dynamic income model. At present, around 7 of the top 10 global mining pools are based in China. However, it's important to note that while these mining pools were established by Chinese operators, the miners and mining machines connected to them are not necessarily from China. Russia has also become a significant player in mining, with companies like Bitfury transitioning from mining machine production to running mining pools. Another Russian pool, Russell Miner Coin, announced plans to raise $100 million in competition with Chinese pools. It is rumored to be owned by Marek Marinik, an internet advisor to Russian President Vladimir Putin. In addition to China and Russia, South Korea has shown increasing interest in mining. Even North Korea, a country that previously had no Bitcoin nodes, has gradually started to establish a presence on the Bitcoin network since May 2017. If you check the Bitcoin Blockchain Explorer, you can see the global distribution of Bitcoin nodes, which demonstrates the decentralized nature of the Bitcoin network. To summarize the lessons from the 6th and 7th lectures on Bitcoin's upstream industry, mining farms are becoming more specialized, with a longer return on investment period, requiring a significant risk tolerance. Mining pools have emerged as a way to consolidate computational power and increase the chances of mining blocks, with two main cooperation models, PPS and PPLNs. Now I leave you with a question. If you were a miner, which cooperation model with a mining pool would you choose, apart from PPS and PPLNs? Can you think of any other collaboration methods? Please leave your answers in the comments section. Congratulations on completing the 7th lecture of our comprehensive blockchain course, From Zero to One. In the next class, I will introduce you to the transaction process of Bitcoin, helping you understand the midstream industry of Bitcoin.